My background covers Drexel Burnham and long-term capital. I'll weave in long-term capital and some points I'd like to make. This historic event is historic in one dimension, and that is the retail side of the fence played a major role in moving the market. I'd like to talk about three areas: the efficiency of the markets, risk management, and clearing and settlement. All three are involved in the GME debacle. I'm using GME as just a generic term for the whole situation. With respect to efficient markets, they always correct excessive behavior. And I think with the GME situation, we saw that the hedge funds were muscling retail holders of GME and AMC and the other stocks into submission. And they got a little greedy. And this usually precedes a major correction in the situation. And Reddit and Robinhood day traders saw an opportunity for the short squeeze. But let's be clear, the short squeeze was executed by the retail side, but it was created by the institutional side. The hedge funds created their own debacle. And that's a great segue into the concept of risk management. And in my mind, it's something I learned at Drexel Burnham. It's the most important aspect of money management. Picking stocks is a difficult game, but risk management is the most difficult and most important. And greed usually trumps risk management. And we're getting back to the concept of how does a hedge fund get into a situation where they have to run to mommy and daddy for $3 billion to bail them out. Long-term capital, same situation. And at the essence of their issues, I mean, they had structural issues in their portfolio. We can talk about the Russian default in 1998, which led to the debacle with long-term capital. You can talk about other things with respect to the hedge funds shorting GME. But the bottom line is greed. They overshorted. They shorted so much of the stock that it didn't take too much of mediocre mathematics to figure out how to conduct a short squeeze. And black swan events usually precede a liquidity crisis. And this whole GME thing is really a liquidity crunch. We could talk about how many shares were so shorted, the entire float, which is evidence of the greed. I would never have a guy trading for me at Drexel Burnham wanting to short 100% of the float. And it's just, I find it just amazing. It's greed, it's avarice, it's hubris, it's all of those things. And the GME was essentially a liquidity crunch to get the bottom line at the stock level with shorting the float, at the hedge fund level with being over levered and over devoted into one position, and at the broker dealer level. I mean, Robinhood wasn't prepared for this from a capital point of view. And on all three levels, we had a liquidity crunch, which resulted in the fiasco, and everybody was pointing the fingers at everybody else. And the hedge fund guys were saying, what the hell are retail guys coming up against us for? And the retail guys are saying, what the hell are you guys shorting the stock? It is worth more than $10. And then you have the broker dealer saying, do I have enough capital? Now, the bottom line of all of this is, and this is not the only solution, but it's one of the solutions, is that if they had same day settlement and clearing, the broker dealer would have known exactly what their risks were, and they wouldn't have had to shut down trading. So I'm sure they shut down trading for many more reasons than that. I don't have the facts. I have opinions, but I do know that if you peel away the facts, you'll find out that trading on a T+2 basis results in a dilemma. I mean, the dilemma is the day traders are generating profits on a real-time basis. They're using those profits. They're plowing them back in, whether they're making them on the derivative side using options or on the cash side using positions and stocks. And they're plowing those profits back into more positions. Meanwhile, those trades have not cleared and settled. The assumption is they will clear and settle, and you have the backing of DTC and the government behind that. But in reality, if somebody on the street is going to default, go under, go into liquidity, all those trades get busted, and you have a domino effect. So it requires every broker dealer to take that settlement risk, and that's what we call it now, settlement risk, to a degree. And they couldn't, take it beyond what they did. Just as a backdrop from a commentary point of view, back in 1987, I was around when the crash happened. And those days it was T+5. So it took 5 days to clear and settle. And we had to shut down Wall Street for, I think, three days in order for the back office to catch up with the trading. So that is an anecdote. So you can imagine when you have T+2, and you had all this wild trading going on, and the hedge funds got into a frenzy too. Insurance companies and other things. No one knew their balance sheet. The hedge fund wasn't sure of his balance sheet. The retail guys weren't sure of their balance sheet. Were they making money or losing money? And what was their margin? How much were they paying for the margin? And would the margin last? And would they be allowed to continue buying calls and all that stuff? So clearing and settlement is something that I haven't heard on CNBC. If anybody has heard that discussed, I'd like to hear what they've heard. But that to me is one area that I'd like to contribute that needs some work in the system. They have to get it down to same day clearing and settlement. And blockchain technology, in my mind, is the only way to go. Of course, it'll take a couple of years to do all this, maybe a decade. But that is the vision that the people running Wall Street should have for the environment we're in. If you're going to have real-time trading, you got to have real-time settlements.
Charles, that's great. You might not hear it on CNBC, but we're hearing it from you, Charles. That's perfect. Why don't we bring Lawrence back in here too and open this up to a little bit more of a discussion? I mean, one thing I was going to ask is, and maybe hope you can kick this off with them. Do we know? I mean, the people I've spoken to all seem to agree unanimously that faster settlement would work. But I guess as Charles mentioned, there's some structure in place there that can't just be ripped out and replaced instantly. So maybe it's just going to take some time. Hope.
Well, why is it still T+2? I mean, why don't we have it yet?
It's a matter of technology. The process. On trade date, everybody sets up to settle the securities and the money. So let's assume there's two broker dealers involved. Someone at Robinhood is buying GME, and someone at Charles Schwab is selling it. So Robinhood is buying for their client, and they have to have the cash. And Charles Schwab is selling the security for their client, and they have to come up with the securities. Now, mind you, the security could have been lent out on a short sale borrow. So if that's the case, and I think there was some of this buy-ins, we call them, where a short seller, and I'm sure it happened in this case, if you're short 100% of the float and people start buying the stock has to come up somewhere for settlements. So the short sellers got bought in. In other words, they had to give up their securities, and that starts a snowball. But it's T+2 because on day one, everybody sets up. Robinhood has the money to buy the stock. Charles Schwab has the stocks. And then on trade day +1, the money and the shares cross over. And on trade day +2, everybody reconciles their balance sheet. Charles Schwab says, I got the shares, and they wire Robinhood, and they wire Charles Schwab. And Charles Schwab says, I got the money, and everybody is whole. In the middle of that whole process, you have DKs, which stands for don't know. So one side of that trade could say, wait a second, we didn't do that trade, or we didn't do it at that price, or we didn't do that many shares. The frequency of DKs is a lot lower. I don't know the number, but that is a monkey wrench that can come in and delay the process more. So right now, with all of the, as John put it, the old world processing steps, which have been automated as well as possible, in my mind. The next level of automation has got to be a complete wipeout of the old way of doing things.
And you mentioned to us yesterday, it's like doing manual accounting when you have the ability to, order McDonald's within half an hour. So we're living in sort of a world that seems, especially for the Robinhood users of the world, very incongruous to what they expect. How did we get to this point?
Good point. I want to just, the thing is, we didn't have day trading. We always had day trading, but we never had it at the level we have it now. And it always existed at the institutional level. You had day trading at Goldman Sachs and those guys, the investment banks, and you had day trading in the hedge fund world. But the retail world, the amount of day traders was few and far between. So what I'm saying is those other day traders could have been controlled. They were controlled by their internal risk management system and the regulators. The retail day traders had no oversight.
I mean, Charles, you seem like a free markets kind of guy. I mean, presumably you think the market should act according to what the participants want to do. I mean, do you have any thoughts on, people making trades when there's obviously something artificial happening?
Well, I am a free market guy, but I do see the need for, supervision on these things. Well, we were talking a moment ago about floating more stock. I was thinking about GME, and the question comes up, why didn't they float some stock when it was trading at $300 a share? And that's been a question I've seen quite a bit come up these past few days, but probably let Lawrence address the legal side of it, this potential class action lawsuit by issuing stock on GME when it was up at several $100s a share, especially if you feel there's no way to use the money to save the company. So if you float more equity and you take the money in and you use that money to delay your bankruptcy, and you can't use it to grow your business or reshape your business, then you're open up to lawsuits for taking advantage of the situation, only to go to zero anyway.
Right. Okay. Hope, why don't you jump back in here? I think we got a couple questions coming in, maybe for Charles and the others.
Yeah, Charles, while we still have you for this portion, and we'll have more time with you, in the second hour. I guess just remind us how we got to this point where these short sellers became so confident in themselves that they were floating, or they were shorting more than the float.
Well, typically a short seller, does the analysis. I'm a firm believer that short sellers know the stock better than guys that own it long. So they do their analysis, and 9 times out of 10, 99 out of 100, they're right. Then they test the water. They short some stock and see what the reaction is, the price volume action. And obviously they hit jello and they just kept shorting more and more. And the retail investors, were dumping the stock out of fear the stock was going and down. And they also come out with their research. We know now that several hedge funds publicized their negative research, which was really targeted not at institutional money managers, but at retail investors. Why are you holding the stock? And they list all of the issues with the company. And they just keep shorting. And nobody was backstopping it on the long side. So they kept shorting it. And that's when the greed comes in. Because there is a point where you should stop. From a risk management point of view, you always have to worry about what's the black swan of this short. And the black swan is a short squeeze. The question is then at what size of a short in aggregate of everybody in the street does it open the way for short squeeze by another hedge fund even? I'm sure there were hedge funds involved on the short squeeze side. And I can't believe they didn't make the calculation properly. It's not a difficult calculation on what it would take to move the short against you. And that's how it evolves. So like I said, it's risk management that gets trumped by greed. They felt they had the retail side against the wall and they pressed it. And then John's point, and here's the free market, when the reverse was put into place and the retail day traders went against the hedge fund managers who were short, they should have let them ride it. And I think they did, because a certain hedge fund had to seek more capital, and they're likely going to, dissolve. And so in that way, the retail investors won. But the other point is regulators stepped in because the street was at risk.
Right.
And so I think the system worked. The system worked fine. It can be better with the settlement issue. That's the thing. I get back to the settlement issue.
Well, it sounds like you believe that short sellers do still play a role in this marketplace.
Yeah, that came up in the 29 crash. Short sellers play a role because they help make the market efficient. Now, I'm not, short sellers that speculate because they see a price, like day traders can short stock because the price volume action indicates the stock is going down. They don't do the analysis. And those are the ones that get hurt. But short sellers play a role. They provide liquidity. They provide pricing. And, I think they're value added. I think there needs to be some sort of limitation placed on to prevent someone from shorting 120% of the flow.
When we saw Robinhood shut down trade of a lot of stocks, and all of a sudden you had Charles Schwab, Merrill Lynch, Morgan Stanley, all of them were stopping buy orders in at least this list of a dozen stocks. And so, people were, talking amongst themselves, is this fair? Is it the right thing? So NASDAQ was not able to be with us today, but we've got a comment here from Karen Snows, head of U.S. listings and capital services at NASDAQ, who says one of our main responsibilities in the exchange is to ensure the capital markets operate fairly and efficiently for all participants. Right now, we're seeing the ecosystem try to balance democratization of the markets with investor protection. But I'll tell you this, some people I spoke to who didn't want to be on the record told me it was frankly disgusting when you could see hedge funds cover their shorts and retail investors couldn't buy stocks that they liked and wanted to support and own more of. Charles, what did you feel about that when you saw it happening?
I agree. I think it was unfortunate that while the institutional players were trying to muscle the retail side by shorting stocks, inviting them to sell into the short, publicizing their research that they were holding onto weak paper, pressing the short continuously, when the retail side, namely Reddit and Robinhood traders, did their own analysis, they realized that they could execute a short squeeze. As I said earlier, the hedge fund side of the fence created their own problem. So I believe the retail should have pressed their bets the same way the short side pressed their bets. The short side pressed their bets to 100+% of the float. Obviously, they were using more synthetic shorts to get above 100%. And the retail side, when they started going long using calls and buying stock in the cash market, they were cut off short and could not execute their strategy to the fullest. Now, it remains to be seen how much of a street problem existed in terms of the balance sheet. That would be the only excuse to have stopped the retail side from buying the stock. And the second factor is, I'm sure the short sellers had buy-ins. Here they are short the stock, and the true owner of the stock, say it's some institution, say it's a pension plan, the stock hits $300 a share, and the pension plan says, sell my 40,000 shares at $300. Meanwhile, the hedge fund, I'm not going to name the hedge funds, but they were sitting on the stock. They had borrowed it, shorted it, and now they had to go out and get it. Maybe they didn't have cash. Maybe they had to go back to their broker dealers and say, we've got to borrow money against our other positions with you to buy the stock and return the borrow. That ends up creating a cog in the street. And so with the, as we said earlier, with the T+2 settlements, it doesn't take much for the street to say, wait, I don't know where the risk is. I don't know who is holding a balance sheet filled with margin risk. We're not even sure these hedge funds can meet their margin call. Their LPs are not going to come up and give them more money. You're not dealing with a Citibank or JP Morgan where the government will bail them out if they get into a margin squeeze. You're dealing with a hedge fund that will say, I'm out of business.
Right.
So, in summary, I agree with the retail side. I think they got hammered a little bit too much. But once we get to see the whole picture, there may be a very good reason why it had to happen.
What happens with a short when the stock becomes delisted? Do you know?
That's a good question. When the short is still in place, but typically when it's delisted, you have, once again, the original owners of the stock that have lent their stock out to the short sellers are calling for the stock to come back because they want to dump it. So you get a lot of buy-ins, or the hedge funds got to cover their shorts to close out the position. And I think the prime brokers, that's another area that hasn't been talked about much. The prime brokers should have known the balance sheet, even though hedge funds use multiple prime brokers. They should have known the balance sheet in terms of what their short position was. And the problem with shorts is that as the short goes against you, it becomes a bigger portion of your portfolio. It's a lot better to be long a stock going down than to be short a stock that's going up. So as the short became a bigger percentage of the hedge fund's portfolio, the prime broker had to know it. And I haven't read anything yet. Maybe somebody has, where any of the prime brokers for the hedge fund stepped in and stopped them from acting as well. So the main thing is that the whole system came to a screeching halt. And I get back to my T+2. If we have blockchain settlements and we can do it, if we can trade real time, why can't we settle real time? We can, but that's the ideal world, so that everybody knows where they stand from a balance sheet point of view and a portfolio point of view. When you have T+2, there's too many question marks. That's a good point, Michael. And I think there's a potential conflict of interest because you had somebody who's involved with Citadel was also involved with the hedge fund that was shorting the stock. And one other player we need to bring into the picture, who I know made a phone call when they got the wind of this fight between the short sellers and the retail side, and that is the banking system. You know, the prime brokers are funded by the banks, Citibank, JP Morgan, and they make a phone call to Citadel or to other players, and if they didn't give them a comfortable feeling that they understood the risk, then the bank says, well, your credit line is going to be, you got 42 hours, 48 hours to resolve this question because we're pulling the credit line. So you get that kind of, cog in the wheel too. So there are a lot of players, and Michael, that's a good point. The banks behind all of that had a play and should be at the table as to what their role was. Yeah, I think the key phrase here is redistribution of wealth. The left, let's use AOC as just a metaphor for the entire crowd. That side of the fence will start with the following rationale. What percent of the population own stocks directly? What percent own stocks indirectly, but not directly? It's for like a pension plan. And what percent don't own stocks at all? And they will focus on the third party. And I don't know the number, but I imagine it's millions and millions of people that don't have any stock investment, either through a pension plan, obviously no 401k, no IRA. And these are the people that they represent. These are the people that they let across the border. So that'll be the focus. I mean, if I was advising her, I would say, let's get the numbers. And let's then talk about how can we help those people by taxing capital gains more, number one. How about they're even talking about taxing unrealized capital gains? I don't know how they're going to do that from an accounting point of view, but that's come up. So, I mean, Janet Yellen said she's willing to think about it. So they're going to think about ways of taxing the people in the markets, especially those directly in the markets like us. And that is not good not so much from a selfish point of view, but from a GDP growth point of view, you want free markets that are regulated so that we have a level playing field, but you want free markets so that capital formation can take place and flow where growth is. And now it happens to be technology, and you want that play to take on. They'll stop that or slow it down tremendously by changing the tax structure. Look what happened to Europe. I mean, Europeans didn't own equities until about 20 years ago. Did not own any equities directly till about 20 years ago. So that's what socialism and that kind of thinking brings.